passive, pampered, lazy. This is how people typically perceive a state-owned enterprise, just like a cat. But today, we introduce an unusual state-owned enterprise, which is transforming into a tiger. Active, aggressive, and hungry. Ladies and gentlemen, this is UEM Agenta. Previously, under the traditional state-owned enterprise business model, Agenta relied heavily on the Malaysian government contracts. Today, it is fast transforming into a dynamic new business model where it competes to pursue commercial contracts not only in Malaysia, but regionally. The largest integrated facilities management company in Malaysia, Agenta provides services to two main business segments. First, healthcare. Agenta provides non-clinical support services to the hospitals, for example, waste management, linen and laundry cleaning. Second, infrastructure solutions. Agenta manages and maintains infrastructure, mainly toll roads. We, from the University of Malaya, issue a buy recommendation with a target price of 3 ringgit and 51 cents, implying a 43% upside. Agenta has a market cap of 2.1 billion ringgit with a free float of 29%. Our buy recommendation is based on 3 key catalysts. 1. Agenta has a solid traditional model with guaranteed revenue stream. 2. It is fast transforming into a dynamic new business model. 3.
1.
Its strong financials propel its transformation.
1. Solid traditional model. Agenta has a proven track record of serving Malaysia government-related entities, especially Health Ministry and Plus, the largest highway operator in Malaysia. These contracts provide a guaranteed revenue stream until 2025 and 2038 respectively, making up approximately half of the total revenue. This provides a solid foundation for Agenta to transform into the new model. Second, transforming towards a dynamic new model. Agenta, the perceived lazy cat, is fast transforming into an active tiger through regional expansion in two business segments. First, healthcare. The transformation strategy began in 2016 to enter Singapore and Taiwan through acquisition. Today, Agenta is the top leader in both markets. Yet, it is still winning contracts arising from the hospital outsourcing exercises driven by the healthcare expenditure growth. Equipped with the credibility from this developed and fiercely competitive market, moving forward, Agenta is ready to penetrate into higher growth and more populous market, where the hospital bed per population is still below average. This is supported by Agenta's technology-enhanced solution. Agenta, like its peers, adopt mechanization. But Agenta's advantage lies in its efficiency and quality of services through an in-house developed application, UE-Track, which has won various awards from the respected Singapore authority.
Next, infrastructure. Agenta has a foothold in Indonesia through its partnership with Astra, the second largest toll road operator in Indonesia. Agenta is currently maintaining 1/3 of Astra's toll road. In our base case, we expect Agenta to maintain all of Astra's toll road by 2023. And we believe in the blue sky scenario, it will go way beyond just 350 kilometers. Why? Indonesia has the world's 4th largest population size, and the number of cars per capita is 9 times below the Asian developed nations average. Furthermore, given Indonesia's capital city relocation plan, the government has a wild ambition of completing a total of 6,000 kilometers of new toll road by 2030. This presents tremendous opportunities for Agenta to pursue deals in highway maintenance services. Agenta is well poised to hunt for more business in Indonesia, underpinned by 2 strong competitive differentiators. First, proven ability in highway maintenance. Agenta has a superb track record in maintaining North-South Expressway. the first, longest, and most important highway in Malaysia for over 30 years. Second, cutting-edge technology. Agenta has a cloud-based system, RAMs, to facilitate efficient highway maintenance. These two strong competitive differentiators will enable Agenta to expand its Indonesian footprint. 3. Strong financials propel transformation. The traditional business model gives Agenta a guaranteed and stable revenue stream. On top of that, Agenta is transforming into a dynamic new model whose revenue grows at a strong 14% CAGR, bringing the firm's total revenue to grow at a sustainable 5% CAGR. Meanwhile, we foresee the EBITDA margin to expand by 70 basis points by 2023. There will be downward pressure from the increasing labor cost and price competition from the new business. However, this will be offset by Agenta's ability to manage its costs efficiently through technology deployment. The top line growth and margin expansion will drive the net profit to grow at a 7% CAGR. But the sky is the limit. In a blue sky scenario, the earnings can be further boosted by acquisition. How can this be possibly done? Agenta's current gearing ratio is way below its peer average. Given the ceiling of 0.7 times indicated by the management team, Agenta can comfortably gear up in order to acquire firms, as was successfully done in 2016. Its capacity for leverage is further complemented by its strong operating cash flow generation.
In the light of Agenta's solid traditional model, dynamic new model, and strong financials, we arrive at the target price of 3 ringgit and 51 cents, implying a 43% upside. We use discounted cash flow model to derive sum of the parts fair value. We discount the business segment free cash flow to firms at their respective WACCs so as to reflect different risks across business segments. Our segmental WACCs are based on the adjusted bottom-up beta. In view of the stock's low free float, we have included a 2.6% liquidity risk premium computed using bid-ask spread as proposed by Professor Damodaran. This is the most conservative spread computed from the 60 observations gathered throughout our analysis period. As a sanity check, we conducted a relative valuation against the IFM peers as shown in the football field chart. This likewise suggests that our DCF target price is reasonable. In fact, at 11 times PE, Agenta is trading at a discount to its peers. We also note that 11 times PE is below its historical average of 14 times due to short-term market overreaction.
Finally, we conduct a sensitivity analysis on WACC and terminal growth rate. Our recommendation will change to a sell call only if WACC increases by 3 percentage points. However, the likelihood is remote given that we have already factored in a 2.6% liquidity risk premium in our base case assumption. Next, we assess our target price in light of some potential investment risks. The two key risks are, first, high dependency on Plus, and second, competition risk in the new business model. Agenta's revenue is highly concentrated on Plus. In the worst case scenario, the Plus contract may be terminated. Our recommendation will then change at most to a whole call. However, this is unlikely given Agenta's proven ability in selling Plus and the lack of other reliable services providers. Subsequently, there is competition risk in the new business. Even if the new business growth
1 minute remaining.
Zero, our target price will still lead to a buy call. And we believe that Agenta has a sustainable competitive advantage given its superior and continuous technology upgrades. Going behind the numbers, Agenta's transformation journey is led by its strong management team. Agenta's corporate governance is also sound. It ranks among the top 4% of Malaysia's public listed companies. To recapitulate, Agenta is transforming from a traditional state-owned enterprise model into a dynamic new model, propelled by strong financials. Ladies and gentlemen, with a target price of 3 ringgit and 51 cents, we affirm a buy recommendation. Agenta, the perceived lazy cat, will be a roaring tiger. Thank you.
Thank you, University of Malaya. We'll now unmute the judges and begin the Q&A period.
Well, thank you for your presentation. I actually see that you're talking about the potential growth of this company. Can you tell me if there's any constraint or limitation for the company to grow?
Right, to answer your question, we would say that the constraint or limitation for this company to grow lies in the policies and also the political situation of the countries that they are marching in. For example, Indonesia is one of the targeted market that Agenta is eyeing on, and it depends a lot on how Indonesia's government is opening to the foreign investors. But we perceive that this limitation is actually minimal, given that Indonesia has opened up their foreign investment policies a lot, and we see Agenta already march into Indonesia with their partnership with Astra, the second largest tour operator in Indonesia.
You showed 3 peers and their price to earnings ratios, and I think they were 12, 16, and 20. Obviously, your company's at the bottom end of that, but that's a huge gap. It didn't seem to be a lot of difference in their EPS growth rates. What do you put down the difference in valuation on a PE basis, and where should Agenta trade given that?
Okay, to answer your question, we can say that scale and reputation is very important in this industry because they provide services to the customers. So in fact, as you can see from the chart, Compass from UK, they are the largest among the peers. So they are trading at a higher PE, and people are willing to pay more for their earnings, every unit of earnings.
Sorry, so you think it's just down to size in terms of the key determinant between those 3 PEs? And if so, presumably Agenta is more at the small end, so would that argue that it's not appropriately valued?
Okay, in comparison, Agenta is relatively small as compared to the international peers, as the international peers have been there already for over almost 100 years. So in terms of the reputation, the international peers, they are already well known to the world. They have their presence in different countries across different regions. But Agenta, a homegrown Malaysian company, they have now embarked on expanding their presence overseas, starting off from Taiwan and Singapore, now moving to Indonesia in the region. So moving forward, there's a huge growth potential coming from Agenta.
Right, to add on your question, we would say that Agenta is currently still invested only by the local investors. There is no foreign investor here for Agenta. So one of the reasons where it is still undervalued in the local share price is because the market still perceive Agenta as a state-owned enterprise. And usually they will think that it is conservative and also highly dependent on government contracts that are waiting to be fed, but we didn't seem so. Agenta is transforming to expand into the private sector, and they should be known to the market because they are one of the stock where it is focusing on Asian markets, where we say that if you believe in Asian market, you should buy Agenta because of the we have seen potential where Agenta is in healthcare and infrastructure. Infrastructure is highly needed in growth markets like these countries where Agenta is in, like Indonesia, Singapore, Taiwan, and also they are having their presence in India and also Vietnam.
Okay, let me ask you a question on competition. So you compared the price to earnings and financials of this company to, or valuations of this company to companies in UK, France, and Denmark. And I assume, obviously, this company might compete with them, but probably they will also compete with other competitors in the region. Have you thought about who would be their major competitors in the region, in Malaysia, Indonesia, or other parts of ASEAN or Asia, who might be even more fierce competitors?
Okay, in fact, we have considered the local peers, the regional peers before we move to the global peers. But it turns out that the local peers are relatively very, very small as compared to Agenta, and they do not have any cross-border operations. They have their operations mainly in Malaysia. In fact, ISS, Sodexo, and Compass, they are Agenta's main competitor in the key markets that Agenta is in, including Singapore, Taiwan, Indonesia, and India.
Can you brief us about the history of the international business of the subject company? I mean, how did they do in the last 5 or 10 years in terms of winning international contracts, especially in key markets like Indonesia?
All right.
All right.
Maybe
So
we'll...
Agenta. Okay.
Okay. Okay, so let me answer your question. Maybe we can show the company timeline from the appendix. Okay, so basically, the company is, we could say, a new and fast emerging company because they just acquired their stakes in Singapore and Taiwan back in 2016. And within just 3 years, we can see that they are already the market leader in both of the countries where previously they are not. And in recent years, they are gaining 67% of the market share in Singapore, which is a lot. And we believe that it further proves that Agenta has the ability because Singapore is always not an easy market to enter. While the company just rebranded themselves in 2015 as Agenta. So at this time, they confirmed their foothold in Singapore and Taiwan, and also in Indonesia, where they will start in healthcare and also infrastructure as their main industry.
Right. To add on, Agenta entered to Indonesian market through the partnership with Astra, the second largest tour operator in Indonesia, and Agenta is the only foreign company that is in Indonesia that is also doing this infrastructure sections. Yeah.
Is it operational partnership or, at a higher level partnership, shareholding partnership with Astra?
The partnership with Astra is through a joint operation.
You are expecting 43% upside for this stock. What may catalyze such a huge headroom for stock movement going forward? What are the catalysts you are thinking of?
Our catalyst lies in the transformation strategy that the company is taking on. It is initially perceived as a state-owned enterprise that is very conservative, but since 2016, they have done a successful acquisition to enter into the Singapore and Taiwan market, and that shows their effort in expanding commercially. And at the same time, this company is not well researched as it's currently done. The research is currently covered by only 3 research houses. So we think that the market is not well aware of what the company is trying to do, their transformation strategy.
To add on, the recent short-term negative factors and uncertainties are keeping the price very low. So this is now an opportunity to buy Agenta stock at a discount, and the share price will start to perform as the market recovers soon.
Okay.
One more question. You actually mentioned that they have very strong operating cash flow. Any dividend policy?
Yes, they have a dividend policy of 50 to 80% of net income.
You highlighted the dependency on Plus, and it looks like your valuation goes down by about 1/3, but you said contract goes out to 2035. Just what are the risks there? Is it about losing the contract, or could there be pricing renegotiation, which makes it much less profitable?
So Plus contributed around 35% of the total revenue to Agenta in 2018. However, we see that the risk of losing Plus is very, very minimal because Agenta is the only company in Malaysia that is capable of managing this highway in Malaysia, because this highway strengths are
Time.
about 700 kilometers.
That's
Yeah.
time.
And we see the risk is minimal.
Thank you.